Good afternoon, good morning. Welcome to our webinar, Fair Lending. No, you are not paranoid. They are coming for you. I'm Marcy Koski. I'm a partner in our Madison, Wisconsin office and the leader of our Consumer Financial Services team. Before we get started, I'd like to cover a few housekeeping items. At the bottom of your audience console, there are multiple application icons for your use during the program today. If you have any questions during our webcast, which we certainly encourage, please submit via the question box. We will try to answer all of your questions, but if we're unable to, or we need to provide a fuller response, we'll certainly get in touch with you after the webinar. A PDF of the presentation is also available in the program materials folder. This program has been approved for legal education hours. For live attendees, report your hours by clicking on the CEU icon at the bottom of the screen. A certificate of attendance, including course numbers, will be emailed to you tomorrow, along with a recording of the webcast for watching and sharing. Toward the end of the program, be sure to complete our short survey. We use your feedback to plan future programs that are applicable to your business needs, so we'd love to hear from you. All right. That's all for the housekeeping needs. Let's get started with our program. Joining me today are my colleagues Maureen Clark, Lisa Lawless, and Leslie Sowers from our Consumer Financial Services team. Our team spans our firm's footprint, which is 25 offices, plus a virtual office called The Link. We represent all types of entities in the consumer financial services ecosphere and advise on all various types of consumer financial products and services. First, let me introduce you to Maureen Clark. Maureen is an attorney in our virtual office. Maureen spent many years at a large financial institution advising its business units on their policies and practices for compliance with ECOA and the prohibition against UDAAPs. This included attempting to translate the language of data analytics into plain English. We also have Lisa Lawless. Lisa is an attorney in our Milwaukee office. She has wide experience representing companies in litigation on an individual and class basis, asserting statutory and constitutional claims. Lisa has also been involved in redlining litigation. Last but certainly not least, we have Leslie Sowers, who is a partner in our Washington, D.C. office. Leslie has advised banks and mortgage lenders on fair lending compliance, including policies and procedures and loan file reviews. Leslie has extensive experience in HMDA data collection and reporting in the interplay with those requirements in fair lending. With that, I'll pass it off to Maureen.
Great. Thanks for the introduction, Marcy. Today, we're just going to cover our agenda quickly. So first off, we're going to discuss what is fair lending. I'm sure most of you are aware of it generally, but we'll go through some of the applicable fair lending statutes and regulations in more detail. Next, we'll cover the current status of fair lending and how regulators are thinking about these laws and applying them, and what actions have been taking place in the industry. Then we'll identify some preventative measures that you can consider in your business related to mitigating fair lending risk. And if there's time at the end, if we haven't addressed any questions that came in during the presentation, we'll try to answer them at that point. Now, let's get started. I'm going to turn it over to Lisa to get us started about ECOA.
Thanks, Maureen. Under the Equal Credit Opportunity Act, it prohibits discrimination against any applicants in any aspect of the credit transaction. It was initially adopted in 1974 because women were being denied credit when they were equally creditworthy to men, or they were denied credit based on their marital status and things like that. And it was adopted within that context. Shortly thereafter, ECOA was expanded to prohibit discrimination on a number of bases. You can't discriminate based on race or color, religion, national origin, sex, marital status, or age. ECOA also prohibits discrimination on the basis of the applicant's receipt of income received from public assistance programs. And finally, ECOA prohibits discrimination based on an applicant's exercise of, in good faith, of any right under the Consumer Credit Protection Act. ECOA also carries with it notification requirements, requiring notification of the credit decision and the entitlement of reasons for adverse action. And we should keep in mind that ECOA doesn't just apply to consumer lending, for family purposes and things like that. It also applies to credit for small businesses, corporations, partnerships, and trusts. The language of the ECOA statute in prohibiting discrimination against any applicant, the ECOA defines applicant as any person who applies to a creditor directly for an extension, renewal, or continuation of credit, or applies to a creditor indirectly by use of an existing credit plan for an amount exceeding a previously established credit limit. That definition has remained the same since 1974, and it's fairly circumscribed to the application process. The people who have a right to assert claims under ECOA are aggrieved applicants. That ECOA gives them the right to a private right of action for violations of ECOA. On the other hand, Regulation B implements ECOA, and it originally was administered by the Federal Reserve, but after Dodd-Frank, that power has been transferred to the CFPB. Regulation B itself defines applicants broader than just persons who apply in applications for credit. However, courts, when there have been arguments that ECOA applies in the context of loan servicing, decisions about application of payments, things like that, after the consumer's already been approved for credit. Courts, when faced with the broad definition of applicant under the regulation, which is beyond just the applicant, it also extends to anyone who has credit, versus the statute that by its terms only applies to applicants, the courts have held that they will apply the narrow definition of the applicant in the statute, and they've declined to apply the broader regulation definition.
Lisa, one thing that you and I have talked about is how in the statute, it switches from using the word applicant to the word debtor to refer to the customer after they've entered into a credit transaction. And as we've discussed here, that certainly does not square with this broad regulatory definition in Regulation B.
True. And our argument under the statute is if Congress intended ECOA's claims and obligations to apply in the context of credit once it's extended to a debtor, then it would have said debtor and not applicant. And so that's one of our various arguments under the statute, that it only applies through the credit application process. Once credit has been extended, we argue, and courts have found, ECOA steps out. Thanks, Marcy. Great question. Next on the Fair Housing Act.
Yeah, so thanks, Lisa. Another law that we see in the traditional fair lending type cases is the Fair Housing Act. And similar to ECOA, the Fair Housing Act prohibits discrimination, but it's broader in certain respects and narrower in others. The act is not limited to credit transactions, and it broadly applies to all, or most, we'll say most, housing related type transactions like buying, selling, leasing, financing, constructing, brokering, and as Lisa just kind of alluded to, potentially servicing of mortgage loans and appraisals. However, it doesn't apply to any transaction that is not housing related, so it's narrower than ECOA in that context. The illegal bases of discrimination under the Fair Housing Act also overlap with ECOA quite a bit in the terms of race, color, national origin, religion, and sex. However, it adds two more to the list for both of these. If we're talking about a mortgage type claim, it would be familial status and disability as well. The cases for fair housing are brought by either HUD, the of Urban Development, Housing and Urban Development, sorry, or the DOJ. And there's also a private right of action available under the Fair Housing Act. Maureen.
Great. Thanks, Leslie. So in addition to the federal discrimination laws, there are also state anti-discrimination laws. And we bring these up because the prohibited bases that might be implicated under the state laws could potentially be much broader than what those federal prohibited bases that both Leslie and Lisa just discussed. So in most instances, they are going to be the same, but it's definitely worth a look to see if there are additional protected classes that you might want to incorporate into your fair lending analysis. All right. And next, we're going to talk about some fair lending recent activity. So Lisa, back to you.
Thanks, Maureen. As alluded to with Regulation B, it broadly defines applicant in a way that would allow the regulator to argue that ECOA applies beyond just the initial application and applies to activities after the grant of credit. In fact, in this spring 2022, the CFPB issued an advisory opinion, an interpretive rule. It was not issued with notice and comment. It was issued as an opinion and effective on the date of issuance. And that opinion opines that in the CFPB's view, ECOA applies to existing credit arrangements, not just applications for credit. The opinion says that ECOA and Regulation B protects applicants who have received credit and are existing account holders, not just those in the process of applying for credit. The opinion is important and alarming and important, and it reflects how the CFPB intends to apply ECOA, and it does apply it in its examination and enforcement activities. Because it's an interpretive rule and not adopted through the notice and comment process, it's not entitled to Chevron deference, meaning courts will defer to it, and arguably we would argue it's not entitled to the lower level of Skidmore deference because we would argue based on the language of ECOA versus the language of the regulation that the ECOA opinion of the CFPB is inconsistent with the statute. And if so, courts should not give it any deference. It's also inconsistent with the courts that have held that and applied the ECOA definition of application, the statutory, and declined to apply the broader definition under the regulations in arguments that it applies to servicing activities. Courts have routinely and commonly rejected that notion, holding that it applies to applicants, meaning applicants for credit. This recently issued opinion tracks amicus briefs that the CFPB has filed in the federal courts of appeal in appeals relating to whether ECOA applies to the decision to close a credit account. Those cases, the district courts held that ECOA doesn't apply because the person is not an applicant at that moment. The Court of Appeals cases in those instances, interestingly, were dismissed. Presumably, perhaps there was a settlement or the appellant decided not to pursue the claims further. Perhaps they didn't want to get Court of Appeals decisions on the matter. There aren't a lot of Court of Appeals decisions. There's more district court decisions on this subject. The advisory opinion states that the Bureau interprets aspects of the credit transaction, which ECOA prohibits discrimination in aspects of the credit transactions as including and encompassing the servicing of that credit, debt collection, loss mitigation, payment plans, settlements, co-signer releases, and certain other services provided to existing account holders. So the ECOA advisory opinion reflects that the CFPB is going to broadly apply ECOA to really the entire life cycle of credit.
And Lisa, that opinion is interesting. It says, and I think that this is a valid policy argument, which is if it's limited just to applicants, while a lender could comply with a COA when they're granting credit, but then later revoke the credit on a discriminatory basis and basically evade the statute. And it's interesting because in preparing for this and in other presentations, we considered whether that appears to be some sort of problem, whether that is or has been historically an issue. And I think we were unable to find any evidence that this advisory opinion was solving. In other words, there didn't appear to be that problem, that evasion that was potentially contemplated in this advisory opinion.
Good point, Marcy. And if Congress had found a problem with treatment of persons during credit arrangements in a discriminatory manner, Congress certainly could have expanded ECOA to apply to the whole life cycle of a loan and not just to applications. Congress has shown over the many years, since before we were all born, that it is willing to adopt laws to protect consumers and borrowers in the context of their debt. And if it intended to, it would if there were a problem.
Yeah, and of course, nobody should discriminate at the point of origination or during servicing, right? But the question is, what does the statute provide for?
Exactly. For theories of discrimination that regulators might examine, pursue, or consider, or consumers or borrowers could bring claims as well. You have overt discrimination, where you have direct evidence that a lender intentionally discriminated on a prohibited basis or expressed a discriminatory preference. You also have disparate treatment discrimination, where there's circumstantial evidence that a lender intentionally treated similarly situated persons differently on a prohibited basis. There may not be evidence of intentional discrimination, but there's evidence of a differential treatment. Finally, you could have a discrimination on a theory of disparate impact, where there's evidence that the lender applies a facially neutral policy or practice uniformly to all credit applicants, but that policy or practice has a disproportionate effect and excludes or burdens persons on a prohibited basis.
Chime in on that too, and mention that under a COA, the jury is still out as to whether that the language of the statute supports a disparate impact theory. In inclusive communities, which address the Fair Housing Act, the Supreme Court found disparate impact was a theory under the Fair Housing Act, but that has not been concluded under the Equal Credit Opportunity Act. And in advising clients, disparate impact, if there is disparate impact, then there's a shift to whether there was a legitimate business need for the practice that resulted in disparate impact, and then subsequently whether there were alternatives that could have been used that would have been more narrowly tailored to avoid or mitigate that disparate impact. So it's a little bit of an amorphous standard to go through, and there is very little COA case law on disparate impact, a lot more in the FHA and the employment context.
Thanks, Marcy. I think we turn it over to you.
Okay, great. So I'm going to talk about UDAAP and discrimination. So in 2022, March of last year, the CFPB announced changes to its UDAAP manual to define unfair to include discrimination. This is despite the fact that unfair, deceptive, or abusive acts or practices and discrimination are each separate statutory terms under Dodd-Frank Act. So in the change to the UDAAP manual, the CFPB is conflating them. Moreover, there is a long history of what unfair and deceptive means, as that's been an authority that has been granted to the FTC for a long time. And in the many years of unfairness and bringing enforcement actions and case law, unfairness has never been tied to a discriminatory practice. But with our aggressive CFPB, turned that on its head and issued these changes to the CFPB UDAAP manual. So what does that manual say? Well, it says that it will examine supervised entities for compliance with consumer protection rules under its UDAAP authority. And in doing so, it will scrutinize discriminatory conduct that violates the prohibition against unfair practice. The CFPB explained in a press release that discrimination may meet the criteria, well, in the press release and also the opinion or the manual, that the criteria for unfairness and discrimination can be unfair in cases where the conduct may also be covered by a COA, or even if it falls outside of a COA. So we just discussed disparate treatment and disparate impact in previous slides as it relates to COA and the FHA. But here, for these changes to the UDAAP manual, the press release accompanying that manual expressly stated that consumers can be harmed by discrimination regardless of whether it is intentional. So this certainly implies that the exam manual update is intended not to capture only intentional discrimination, but also disparate impact. Chopra and the Bureau, they've been called out on this, and they've had confusing responses. So the Bureau, one of the assistant directors, noted that there's never been an intentional standard embedded in the unfair prong, and further stated that 3 prongs of unfairness, which I'll tease out in just a moment, would have to be met to be an unfair practice, and that substantial injury, which is the first prong, is not enough. So he seems to say that, yes, you do have to meet all 3 prongs for there to be disparate impact, and disparate impact is possible under the change to the UDAAP manual. So let's talk about what the manual says with respect to unfairness. So first, as a reminder, unfairness, the 3 prongs are an act or practice is unfair if it causes or is likely to cause substantial injury to consumers, which includes not only substantial injury to one consumer, but could also include small injury to many consumers, and that would be sufficient to be substantial injury. The second prong is the injury is not reasonably avoidable by consumers. And the third prong is the injury is not outweighed by countervailing benefits to the consumer or to competition. Unpacking these elements and comparing them to the manual, with respect to the first prong, it causes or is likely to cause substantial injury to consumers. The manual says that foregone monetary benefits or denial of access to credits or service, to products or services, like that which may result from discriminatory behavior, may also cause substantial injury. It further states that unreasonable debt collection, harassment, or discriminatory conduct, emotional impacts or dignitary harms may also amount to or contribute to substantial injury. This is aggressive. In litigation, as I think Lisa would certainly attest to, proving emotional distress is a really tough burden. It cannot be a conclusory claim of emotional distress, and a court will often require corroborating evidence. Even then, a court is loath to find emotional distress damages. So the change to the UDAAP manual in this regard certainly is pretty explosive. The second prong, the injury is not reasonably avoidable by consumers. In the exam manual, there's a presumption, and I think it's a logical presumption, that an exam manual could not reasonably avoid discrimination. If someone intends to discriminate against a person, that person would not be able to reasonably avoid that discrimination. With the third prong, The CFPB is absolutely silent on how the third prong plays into this discriminatory analysis. There's absolutely no comment on the countervailing benefits to consumer or competition. And again, logically, could there ever be a circumstance in which discrimination would be outweighed by countervailing benefits to consumers or to competition? Comparing injury to the consumer compared to the cost to the lender of not discriminating, perhaps that would be one step in an analysis. So that's what the CFPB runs through in its manual in unpacking how a discriminatory practice can be unfair. A very open question on the change to the UDAAP manual is there a prohibited basis that is outlined? Are there protected classes like there are in ECOA and the FHA? And the answer is no. So it just uses the term demographic. A regular dictionary definition of demographics is the statistical characteristics of human populations such as age or income used especially to identify markets. We've discussed how under ECOA, for example, a member of the military is not a protected class. It could be, though, a demographic that is protected from discrimination under UDAAP. And why I bring that up is that the Military Lending Act has specific requirements on how to lend to members of the military and their family. If a lender has a product that they're unable to provide to a member of the military at the capped MAPR of 36%, and therefore they cannot lend to the member of the military, there's no ECOA violation because the member of the military is not a protected class. However, under the change to the UDAAP manual, question whether potentially that person would be in a demographic that would be protected under UDAAP. For our credit unions, also question whether a person who is within your field of membership, or rather who is not within your field of membership, if they apply for membership, you can't grant them membership because they're not in your field of membership. Could that somehow give rise to some sort of unfair claim? The point is, we don't know. The changes to this UDAAP manual are difficult to comprehend and certainly difficult to put into practice. In fall, several trade groups, including the U.S. Chamber of Commerce, sued the CFPB to challenge the manual update. The complaint asserts that the new theories of disparate impact liability are not provided by the statute, and the CFPB has exceeded its statutory authority by its changes, and also argues that it's a legislative rule that was not properly subject to notice and comment. The CFPB has moved to dismiss the lawsuit. It appears that briefing on that motion was completed just a week ago. So now it sits with the court to make a decision. As many people on this call know, another case out of Texas and then the Fifth Circuit has ruled that the CFPB's funding was unconstitutional. So that was also an argument that will be considered by the court.
Yeah, and the trade association groups in the U.S. Chamber of Commerce and that Texas action have filed a motion for summary judgment asking the court to rule as a matter of law that the CFPB exceeded its authority in adopting the revised examination procedures, and that these are just really issues of law that arguably the court can decide and issue a decision on whether they are valid or not, whether they're constitutional or they exceeded their authority. And I also wanted to make note that the ECOA advisory opinion and the revised UDAAP examination manual provision, there's PDFs of those in the resources page, which is in the last page of our slides.
Great, thanks, Lisa.
So, while much attention has obviously been given to the CFPB's UDAAP manual changes that Marcy just went over, and rightly so, it's important for everybody in the consumer finance service space to really take note of all of the recent enforcement trends we're seeing, and as well as the various different initiatives that we're seeing come out of the CFPB and other regulators, honestly, even if you don't fall under the CFPB's direct purview. Is briefly highlighted here on this slide, and I welcome my co-panelists to chime in as we go through these. There are other regulators that are taking this, that are going the same direction. The FTC, the FDIC, the DOJ, many state agencies and AGs, they've all been following a somewhat similar trend on this fair lending scope expansion, if I want to call it that. We've seen a significant amount of enforcement in the traditional fair lending space, although it has generally changed direction, or it had a new focus. And we haven't quite seen the CFPB use its UDAAP authority in that context yet. That being said, the FTC did just last year, last fall. It was in an auto dealer case, and they, for the first time, alleged that pricing discrimination was an unfair practice and violation of the FTC Act, in addition to being a violation to ACOA. So they really didn't have to bring that claim. They doubled up on it, which was very interesting. And they said that the discretionary markups and interest rates and so-called junk and add-on fees that were added by the dealer were having an impact, a discriminatory impact on Black and Latino customers. So while this is the first, it feels like it most likely will not be the last. And it's only a matter of time till we see more of this. And so stay tuned. One thing here that is pretty, I guess, traditional is the focus on mortgage lending. And this is really because so much more data is collected and reported on mortgage loans. It's publicly available. It's just so much easier to flag potential issues here. So we'll talk about a little bit about that data element in a few minutes. But there is that new focus that I was talking about. We're seeing redlining applied to non-bank lending instead of just banks under the Community Reinvestment Act. We're also seeing servicing, and appraisal bias has gotten a significant amount of attention recently. We've added a link to where you could actually see the CFPB's hearing back in January on that issue in the resources slide. There's a video, there are lots of other materials if you're so interested. It's a very hot topic. A quick internet search can get you to a lot of different people talking about the appraisal bias issue.
Leslie.
Yes.
On the redlining issue, one case that's been really interesting to watch, and I have to go back and check its status, is the Townstone financial case, which was brought, the allegations are that the Townstone financial owners had a radio show on a conservative talk radio station, and the comments that they made, as alleged in the complaint, indicated discrimination and discouraged applicants from applying to their mortgage broker for applications. And I think that's pretty much unique, that there really hasn't been much on, okay, well, you're doing this in the social media or this in on talk radio. So anyway, I pointed out because, yes, we have these traditional redlining cases, and they certainly continue, but this one is just a little bit unique, has some nuances to it.
Agreed. It's definitely a different approach than we've seen in the past in those traditional redlining cases. And I think that does bring up that point of what is important in sense of your advertising and marketing, particularly for non-banks who traditionally haven't had that outreach aspect necessarily to all aspects of their community. This brings that in I think that that's something that non-bank lenders need to focus on a little closer than maybe they ever did before.
And along with that, Leslie, I think not just the non-bank lenders, with the CFPB's interpretive rule in August about what the definition of service provider means, digital marketing providers are sort of on notice as well with that expansion of the UDAAP exam manual to include discrimination. That interpretive rule talked about the term service provider and went through the definition, talked about the exclusions from it. The two exclusions are that a service provider either doesn't provide a support service of a type that's provided to business generally, or a similar ministerial service, or the time or space for advertisement for a consumer financial product or service, and then goes on to distinguish digital marketing providers from those two exceptions very specifically, that because they're so involved in content strategy, from the distribution of the content, the creation of the content, deciding who gets to see it and when they get to see it, that material or the support service and being it material or a ministerial service does not apply. And then also getting to that other exception of time or space, that because it's not similar to a traditional newspaper where you just are taking that one spot in the newspaper or in a phone book, something that used to be printed, that doesn't exist any longer. And there's so much analysis of thousands of pieces of customer data to determine how best to distribute those advertisements, that digital marketing providers are no longer excluded from the provision of consumer financial products and services.
It's a great point. Definitely, what I'm finding interesting about these trends in particular, like you're saying, is the focus on discrimination in other non-mortgage type scenarios. Outreach to other loan products, and with the UDAAP expansion, obviously there's an expansion towards non-loan products, non-credit. All your other financial services and products would be incorporated into that, because like the missing bases of discrimination in the UDAAP manual, they also did not limit it in any way, shape, or form, and seem to do that intentionally to any particular credit product. They did in fact talk about having a deposit account be counted towards, fall under the UDAAP scope, which has never been the case in the sense of ACOA or even Fair Housing Act. So,
and Leslie, that makes sense, right? That's an obvious example of what would be discriminatory conduct, right? But the question is what less clear examples fall within that change to the UDAAP manual?
Yeah, and that's something that I think was part of the complaint with how the CFPB went about those changes, without a whole lot of clarity as to what they would apply this to. Presumably, we would have to go with anything that any sort of consumer financial product or service that comes under their purview. So,
which is a lot. Exactly. It's a pretty long list and doesn't really limit it very much. So I agree. I think that not having the rulemaking process to really give the industry the time to think about what products and how they can adjust their policies and procedures is definitely a little bit cause for concern, to think of looking at everything more specifically with this fair lending lens.
Many of us were at the American Bar Association Consumer Financial Services winter meeting in New Orleans just a couple of weeks ago, and an audience member to the panel brought up a very good point, which is that process matters. The process that's used substantiates any process that is subsequently implemented, and it validates it. And the failure to utilize the process that is required by law really throws shade on things that come out of basically nowhere.
Exactly. I think what's interesting here is, even if the CFPB backs off or is forced to back off in any way here, or has to go through some rulemaking, we're seeing it from other regulators who have different statutory authority. We are also seeing it from both state and federal that have different authority, although most of them are also pulling it under their UDAAP as well, their version of UDAAP. But we're also seeing movement from Congress. We're seeing proposed legislation on this topic that over the last year or so, where they want a focus on fair and affordable access to financial services and products, not just lending. In fact, just late last year, they had the Senate Banking Committee had a hearing on that was entitled Fairness in Financial Services, Racism and Discrimination in Banking. And so this is a push from multiple directions. And while we like to blame the CFPB for everything, it isn't just them. And so it's really important that we keep track of this from all the various different places that we're seeing it and take note of how best to mitigate these things.
Agreed. Leslie, I think in part with that, with just banking services, tying that back into that state law of what prohibited bases are included there. And also, as you noted here, the limited English proficiency customers, that there are state requirements for those too that can be closely related to the Fair Lending Acts and regulations by state. So that's an important place to consider as well as you're getting your products ready.
Yeah, absolutely. That's an excellent point. And, you know, the I guess, general nature of the last bullet point here on the slide to that point, it was very much encouraging lenders and banks and financial institutions to ensure that their processes were in a way that would make it where there would be access to fair and affordable financial services and products to immigrants and LEB customers. It wasn't a mandate. There was a little bit of guidance on how to do that and what they would recommend, but not a whole lot of analysis of how that played into different things like state law requirements of disclosures in different languages and things of that nature. So there's a lot to consider when you're trying to adhere to best practices or what the CFPB considers best practice and is incentivizing versus also trying to stay within the limits of the law.
One of our attendees, Kevin, helpfully pointed out that there's an annual fair lending webinar put on by the FRB and the CFPB and other government agencies, and you can find it at the Outlook Live site. And actually, you can watch an archive of the webinar from December and see all their materials. So we can see it, see the info from the other perspective. Thanks, Kevin.
Yeah, that is a good webinar. There's a lot on appraisal bias, if that's one of your concerns too. Well, let's see. So, we'll kind of hit on this a little bit before we deep dive into some other things, but these are really, a couple slides on how to identify and mitigate risks associated with everything we've talked about here. While, hopefully we haven't scared you, but if we have, we might give you a few tips here on kind of a way to try to start working on identifying these things that maybe we should think about changing. I like to think of this as kind of how do I keep my company's name out of the headlines, which is everybody's main goal, I think, here. Really, this is all about having a good compliance management system. This is about top-down sort of considerations of ensuring that your board and your C-suite is on board with this, is well-trained, understands, and fully appreciates the fair lending and UDAAP claims that are being raised, that are being discussed, and the underlying facts at issue with that as well. This is ultimately the only way to really lessen your risk presented by these trends. You have to be able to apply those facts and those scenarios to your entire business practice, all of your business practices, because we're no longer limited to lending and credit or housing. We're now everything that potentially a financial service provider does. And so you need to kind of think through it holistically, top down, side to side. And what your actual practices are matters even more than what your written policies say. So that's important too, to make sure that while you can clean up your policies and your procedures and make them look beautiful, if that's not really what's happening, that's not going to help you all that much. And I would say, one thing to consider here is really to involve more diverse players into this discussion and to this process. Listen to their perspectives, their concerns and suggestions. They may have something to share that you wouldn't think of yourself. And I think that would be very helpful in this type of discussion and conversation to try to identify these types of fair lending risks. Another thing that I'll just hit on real quickly is training. That goes to the top-down, side-to-side sort of compliance issue. Train everyone, keep them on, and do it often. The more often you do it, the more it becomes a culture of compliance throughout your company. We've kind of talked through some of these things here. We will, but what I want to focus on really is get to the stuff that maybe some people want to talk about or hear about, is the self-testing and evaluation process. This is the only way to really know whether your company is complying, statistically speaking. And this is what the CFPB is going to do. This is what other regulators are going to do. They're going to do some testing on some data about your company. So briefly, we wanted to say, to bring up this lovely Reg B exception here for self-testing. And because what's important here is that, as many of you probably realize, ECOA prohibits the collection of certain demographic data, specifically race, color, religion, national origin, and sex of a borrower, with some exceptions, unless it is required or otherwise accepted under ECOA, HMDA, or some other applicable law. So obviously mortgage origination can collect this information and must collect this information in most cases. But what do we do? Reg B only specifically permits the collection of this information in the context of a self-test for any other credit product outside of mortgage where it's not required. And in order to receive that permission and the privilege protection that this provides, you have to meet the definition there on the slide. In particular, this creation of data or factual information that's not available in the files is, I think, the biggest stumbling block. This would require, the use of fictitious customers to test your staff and operations, submission of fake applications, surveying of loan applicants, things that are outside of the actual loan data file. To my knowledge, very, very few lenders do this type of testing. Most lenders I'm aware of do what regulators would consider a self-evaluation. This is where you take your loan data, and particularly mortgage lenders do this quite frequently, or they should. They take their loan data and run it through a statistical analysis to determine if, in fact, they have any issues or apparent problems based on the actual data of their applicants and borrowers. Because the critical data needed to do a fair lending review is not allowed to be collected outside of the context of mortgage, other than in the self-test, which I don't think many people do. What do you do to conduct appropriate self-evaluations to ensure compliance with ECOA, with the Fair Housing Act, and now with UDAAP, on a broader scale? I'm going to turn it over to Maureen to kind of get into this process a little bit more.
Great. Thanks, Leslie. So first, before we get into how you actually get that data or use it to do this sort of data analysis, just wanted to give a little bit of background on where that exam process how you can prepare for that exam process. The Interagency Fair Lending Examination Procedures is a great place to start. It describes the basic framework for fair lending exams that might be conducted by the Federal Reserve Board, the FDIC, NCUA, the OCC, and also the CFPB. So when in that exam procedure, it gives you some structure of these are the things that they're going to want to collect from you. So as Leslie just talked about, your policies and procedures, your training, all of the things that are needed for that strong compliance management are things that regulators are going to want to look at. So starting there is a great way to begin to put yourself in the best position for an exam. And then they also provide some great risk factors when it comes to underwriting and steering, redlining, pricing, all the places that fair lending risks are going to appear the most. So you can look at those different risk factors and kind of run them up against your data and your policies and procedures and give yourself a preview of what an examiner might focus in on. And then again, as Leslie said, your overall compliance program strength is one of the greatest things that you can have prepared to be ready for an exam. So once you are getting into analyzing your data for those non-mortgage credit products, again, you generally can't collect the data for race, color, religion, national origin, or sex of an applicant. So how do you perform the data analysis? Well, the CFPB has, although somewhat, there might be some questions about this, and it's been discussed frequently, but they've recommended the use of a proxy method. It's called the Bayesian Improved Surname Geocoding Proxy Method. And essentially what it does is takes geography and surname-based information from census tracts and applies it to your customer's information as a single proxy probability to assign race and ethnicity to your customers. And that gives you the opportunity to perform that analysis similar to when you're using HMDA data and give yourself some indication of whether there is that underwriting, that pricing, those kinds of risks for fair lending. And that's probably as far as I'll go in depth of what that looks like, unless my co-presenters have any questions, because that's when I start to speak like a data analyst and it may not come across correctly.
Maureen, so how does a company or a lender protect itself in conducting this analysis from potential discovery in litigation or exams or enforcement actions?
I think the best part is to just really document exactly what you're doing. You're as Leslie said, of the self-evaluation, there's not privilege for this. So you need to make sure that you're doing all of your steps, documenting them to show exactly where you started, how you did this, keeping your data in place. And if you do, I think also have an issue management process. If you identify an issue, make sure you have a process for how it's going to be handled instead of just pretending you didn't see it and saying, we'll come back to that later. So I think that issue management process and having, again, that policy in place or that procedure on what you do with information that you're getting from these self-evaluations is a great way to prevent any risk there.
And I think you could impart privilege if you involve an attorney in the process, right? So if you have an attorney directing or managing or assisting, that could give grounds to assert attorney-client privilege or attorney work product, certainly, right?
Yes, great point. Yes, exactly.
And then one thing I know you and I have been working on a lot with are business justifications, right?
Yes.
And so can you just maybe talk a little bit about how a lender would go about documenting a business justification? And as a reminder for the audience, for disparate impact, if there's a neutral policy or practice that results in disparate impact, you may be able to rebut that if you have a legitimate business need.
Yes, exactly. So for that disparate impact, say you identify that in some of your data analysis, if the disparate impact is a result of a neutral policy or practice, one way you can, protect your information is to say, here's our neutral policy or practice. We're going to document the legitimate business need for why we make this practice occur for how we practice it in our business. And then not just saying that. I think what we have found in our research recently is that there's not a strong support of exactly what you need to document. Regulators have given us some indication that it can't just be a hypothetical business need. It needs to actually be related and have some impact on that practice. So you could have documented your neutral policy, identify the business need that supports why that policy is necessary, but then provide some data to back up how that business need is important, as well as identifying that you did look at other policies or practices that didn't result in a less discriminatory effect or didn't achieve that purpose that you're trying to achieve with that neutral policy.
Great.
All right.
I agree.
Next, so now we're going to talk when you actually have you've gathered your data, you've applied the BISG proxy method to it. Just generally, as you're starting to do your analysis, you want to have two groups, a control group and a prohibited basis group based on where you've applied the proxy method. And then you want to compare those two groups, but keep your focus on those applications that are ones, especially for underwriting and approval and denials, that are on the edges. So if you have some, discrepancy or some discretion in why they were approved or why they weren't, focus on those to really dig into where your practices and policies might need some updates. And then finally, as we discussed a little bit, what to do with your data analysis, and make some policy and procedure updates if you do identify that there might be some disparate impact that's occurring. Have a process for documenting your business justifications and keep them updated. Don't put that in there and then address it 4 years later. Have a process to periodically look at that and make sure that the data that you're using is still supporting the justification that you have identified. And same, going back to Leslie's, make sure you're training appropriately. Looking at everything that is coming in from all these industry players and saying, this is all the things you need to consider. It's a lot of information, but having that periodic training will really keep it top of mind and keep you prepared. And then one other thing is just to look at your market areas and aligning them with the CRA assessments if that's applicable to your business.
Okay, the final slide with 4 minutes left. So let us just touch briefly on vendor management. So many companies and lenders, of course, utilize vendors in their day-to-day business. And just a reminder, and since CFPB came into existence, there is a sharp focus by the CFPB and, of course, other regulators on downstream vendor management. A covered person under the Dodd-Frank Act is certainly liable for acts and practices undertaken by a vendor. So it's very important, particularly in this day and age with the use of models, algorithms, and other decision-making processes that may be outsourced to a vendor, to just keep your eye on exactly what is going on with that vendor. Recently, as we mentioned, there was a black box pronouncement by the CFPB, which said if you're using a quote unquote black box to make credit decisions, you nevertheless need to be providing an adverse action notice that delineates the specific reasons that you've denied the credit in conjunction with FCRA and ACOA. So reminder to be sure that you're looking at your vendors downstream, testing them, making sure they're contractually obligated to you to comply with the prohibition against UDAAPs and ACOA and FCRA. And likewise, there is this idea of upstream vendor management. So, for example, if you're considered a service provider, as we touched on earlier in this webinar, if you're a service provider, you're liable for UDAAPs. You may not be technically subject to some regulations, but certainly the CFPB and other aggressive regulators could take the position that a technical violation of a law that doesn't apply to you could nevertheless be a UDAAP. So very important to be keeping in mind, both from the service provider perspective and also from the financial institution and lender perspective. On that, we will take questions. If anybody has them, you can pop it into the Q&A. Otherwise, we are grateful that everybody attended today, and we have some closing announcements. As a reminder, you can get CLE for this webinar, and so to report your hours, click on the CEU icon at the bottom of the screen. A certificate of attendance, including course numbers, will be emailed to you tomorrow, along with a recording of the webcast for watching and sharing. And please be sure to complete our short survey. Please give us feedback on what you liked and didn't like about today's webinar, how we can improve, what sorts of topics we can bring, relevant topics that we can bring to you for your business needs. The last page, as I'm showing, is a page of resources. Again, that's in the PDF copy that is in one of your applications at the bottom. So this concludes our webinar. Thanks so much to the audience and to Maureen, Leslie, and Lisa. Thank you.
Thank you.
Thank you.